And here's what I did. I went and I started asking people I knew, hey, how do you deal with your mortgage? I mean, you borrow $300,000-$400,000. What's your plan? Like, how do you get out of it? And every person I asked gave me a different answer. So my conclusion was, I don't think any of them know either. I think everybody's just kind of winging it, right? And the fact is, most people are winging it. In fact, if you ask people how they go about paying a mortgage, typically the answer you'll get is, well, I save, and I make lump sum payments, or I pay bi-weekly, or I pay weekly. And so I started looking into this because I didn't trust anybody. And what I found is what I'm going to share with you tonight. It's something we now call the method, okay? And it's how to pay a mortgage off in half the time without making extra payments, which sounds absolutely ridiculous for me to stand up here and say to you. But an hour from now or less, you'll know exactly how to do it, and you'll know that it's only simple mathematics. And had you been taught what I'm going to show you before you were taught how to do the banking the way you do it today, you would never, ever have done it the way that you do it today. 12 and a half, that's what I'm going to show you tonight. And I'm going to show you dramatic interest savings. I wouldn't call you all here and come show up and be doing these workshops to show you, say, $5,000 of savings. I want to show you how with the same money, the average two-income earning family can pay that mortgage off in 12 and a half years or less and save over 65% of the interest that will accrue on that mortgage during that time. It sounds too good to be true. It's not too good to be true. It's math. And you really have to wrap your head around that. We've all been kind of taught how to bank by the bank. And the bank has an interest, right? The interest is making money. And they make 30 seconds or so, or take the rest of the night. I want you to try and think about the details of your mortgage because I want you to be aware of what you're not aware of. You should know all the details of what is, for most people, your largest liability and the most aggressive interest-bearing debt. But unfortunately, most people don't. And here's why. We were never taught any way to manage a mortgage. Everybody's winging it. You know, when you go to high school, knowing what I'm about to show you now, you'll probably agree at the end. Everybody should be taught how to do this because almost everybody's going to have a mortgage. And for almost everybody, it's going to be their largest liability and their most aggressive interest-bearing debt. So average daily balance. But if I was to start with a high balance and end with a high balance, but during the month I was to carry a much lower balance, I'd pay interest down here. It doesn't make sense to you right now, but that would be the ultimate strategy if you could make it happen. I'm going to show you how you make it happen inside of the system. Okay, so here's what we're going to do. I'm going to show you how to put all three of those accounts together in a systematic way, utilizing the good and taking away the bad. Okay? So we've got three accounts. We got a mortgage, we got a line of credit, and we got a credit card. Now understand this. What I'm about to show you is revolutionary different from what you're used to. And if you've been banking with a checking account and a savings account all your life, you're not going to do this walking out of here tonight and remember it all and be able to do it the first time. It's going to take a little bit of training yourself because you're always going to revert back to what you already know. So you've got to start a new habit. Well, let's start the mortgage at 5.15%. Okay, we'll put the line of credit at 6%, and we'll put the credit card at 19.99%. There's 15 years from now. We need to do this and redo it every year. We need to determine what's possible for this year and climb that mountain. And then next year, reevaluate. You know, I have a 2.5-year-old who was a total game changer when she came along. She's the greatest thing in my life, but she changed everything for us. And the very next year we had her, we had to do this all over and very differently. So we're trying to, and you have to understand something about a mortgage. Once the interest is there, you got to pay it. It may take you years to pay it off, but you got to pay it, and it keeps charging interest on itself. It's relentless. It doesn't care if you lose your job. It doesn't care if you have 15 children. It doesn't care. It just keeps going and going. We have to take an approach that's more like Eastern medicine, preventative medicine for your mortgage if you want to get ahead. We have to get to the interest before it gets there. We have to eliminate it or block it before it actually gets charged. So here's how we do it. I told you got $29,000 of savings in one fell swoop right off the bat. And you're investors. How many people know somewhere you could take $9,000 and tonight, with guaranteed, you could get 3 times your money back, taking no risk? It's almost unheard of, okay? The only guys doing it are bookies, okay? So the point is this is an unbelievable transfer, but now what you've got is this problem to deal with, agreed? And we've got to show you what that problem looks like in order so you can see that it's actually not going to hurt you and take away from your savings. So you saved $29,000 here, and one of the common questions I get right off the bat is, this doesn't make sense, Chris. You moved $9,000 from a line of credit at 6% to a mortgage at 5.15. How's that even possible? Well, it's because of the way the two charge interest. It's a mirage, okay? They don't charge interest the same way. Simple, average daily balance, monthly, daily compounded twice a year. Totally different ballgame. People don't know, okay? So I'm gonna show you how you manage this, and it's really simple. It's so simple, it's almost comical that we never was taught when we were kids, okay?